What's going on, guys? Welcome back to the channel. In this video here, we're doing a stock analysis on Canadian Tire. Now this one's for all my Canadian friends. Canadian Tire it's like a general hardware store to outdoor activities. It's like the go-to. It's a mix between, imagine, Walmart and Home Depot for my American friends who are watching. So we're loading this up in the stock research tool here. Now this company trades on the Toronto Stock Exchange. I haven't really covered any Canadian companies, and also showcases that my software also covers Canadian companies as well. So sitting at $169.09 at the time of closing, this company is actually doing fairly well. We're scoring this company a 9 out of 10, and that's pretty good. So there's a lot of things that Canadian Tire is doing well, and one minor thing that they are doing wrong, which we'll get to in a second. So with my financial evaluations category here, folks, it takes a look at the cash flow statements, the income statements, and the balance sheets, and grades this company out of 10. As I said, we're scoring it a 9, so we'll go through these categories and figure out what they're doing right and what they're doing wrong. So with our 5-year PE average, we're sitting at 12.86, incredibly low, folks. We want to see this number underneath 22.5, and we have that no problem. And as well as our current ratio sitting at 1.72, that's pretty good. We want that number over 1.5. Return on equity is 17.72. It's over our 15% threshold. That's what we're looking for. Massive EPS growth. They are not diluting you. They've actually been buying back shares in the last 5 years. 7% of shares have been bought and back. We love to see that number decreasing, folks, because that means you have more ownership of the company. So if we even go into our charts section, we can just see what's going on, and we can see that number slowly decreasing over the amount of time. So it's great to see that. Okay, going back to the main page here. So we have net income growth, free cash flow growth, return on invested capital sitting at 10.84%. That's great. We want to see this number 10% or higher. And we have revenue growth, small revenue growth. It's only 5%. It's a $10 billion company, so it's pretty small, relatively speaking. And the only part where we're getting dinged is our debt to equity ratio. It's not looking too great. We want to see this number underneath 50%, and we're currently sitting at 106.86. It's not great, folks. We want to see that number low, because that means that they're growing the business through equity and not through debt. But in the case of Canadian Tire, they are growing this business through debt, and we don't want to see that, because in the case of a recession, which Canada is looking to be headed, because we always pretty much trail behind the United States in some aspects, this can create a ding for this business. So something to just keep in mind, keep in the back of our heads. Now, let's look at our company metrics and see where this company lies in terms of how they're doing over the last 5 years and where it compares. So far with our financial valuations, everything is looking pretty good. Like massive free cash flow growth, massive net income growth. They're buying back shares. It's looking all happy. And just to see where it's been lying here, see if there's any kind of discrepancies. We do pay out a small dividend, 2.93%, and that comes out to $271 million paid out. Our average free cash flow is $23 million. So $800 million on average, so they can easily pay out those dividends, no issue. And our current trailing 12 months category, it's $1 billion. So we can easily pay off our dividend. The return on invested capital is actually higher than our 5-year average. A mediocre Piotrowski score, a questionable Allman Z score. However, they are up on their 5-year average in terms of profit margin. Same thing with return on equity. There's a lot of things going well for this company, as well as our PE ratio is down. And this company over the last little while has been on a little bit of a decline. We hit a high of 206.97 in our 52-week range and low of 159.36. So we're still low compared to what we used to be at. So we'll see if this price is justified. So far, I'm actually liking this a lot. So we're going to go into the next section of my software here, and that's the price analysis section. And we can go from 1 to 20 in terms of years of evaluation to discount the company, the projections that we're trying to make, to figure out what we should be paying for the company today. We're going to do a 10-year evaluation here on Canadian Tire. I'm going to fill out these boxes, and then we'll talk about it. Okay, folks, I'm going to bring you back over to the price analysis section here. So if you're new to the channel, I like to stay conservative as possible because that allows me to have an ample margin of safety. And that's what we're trying to do here on the channel, folks. Analyze companies from a fundamental perspective, but also put a decent margin of safety in. That way, in case we are wrong, we're not wrong so much. So 10-year valuation and keeping my revenue growth at 4.5, and 5% based off my historic numbers of 5 and 10 years. And profit margin, I'm keeping that somewhat the same, as well as free cash flow margin, somewhat the same as well. Now, PE ratio and price of free cash flow, I've gone off of 9, 10, and 11. 10, 12, and 14 for our price of free cash flow, and PE ratio 9, 10, and 11. Based off the fact that we're currently hitting 9 for our PE ratio in 12 months, and our average has been 12.86. Desired return of 13%, and we're going to calculate this, folks. And folks, if you're enjoying the video so far, make sure you hit that like button and subscribe button. I put out investing videos Monday, Wednesdays, and Fridays. So if you don't want to miss any of these videos, make sure you hit that button and the notification bell. As well as, if you want to get your hands on this software that I have in front of me, stay tuned. I'm working diligently to get this out to you, my viewers and subscribers. That way you don't have to wait for me to make any analysis videos. You can just go ahead and put out any kind of company you want to take a look at. Jumping back into the software, take a look at this, folks. Current price is 169.09. Our average calculation comes out to be 185.29. We are currently crushing it on pretty much all these numbers here. Green on the aggressive category, almost on the moderate, and we're almost there. 145 is our conservative average. You know what? I think anywhere south of 180 would be fairly decent. And I'm using fairly decent revenue growth numbers. And now I wonder if I was more conservative, what that would mean for us. I'll keep that as 3. Go 4. Let's go 4.5 and calculate and just see what that comes out to be. So, folks, even with the revenue growth numbers change, I did 3, 4, and 4.5. Our moderate average still checks out. Our average calculation comes out to 174.20. It's 174.56 being our moderate average. So yeah, what I'm saying here, folks, anywhere I guess south of 180, Canadian Tire would potentially be a buy. Now, does that mean you should go out and buy this company? No, this is the start of your due diligence. You should definitely take a look at other facets of this business. Who's running it? What are their plans? What are they trying to do? How are the stores running? And with my software, you can do all that. We're definitely just scratching the surface, and my software here provides all that information, provides what the company does, any updated news that may be reported on this business, as well as we have access to the income statements, the cash flow statements, balance sheets, so on and so forth, as I have expressed, as well as our charts function here. And there's more features coming up. There's more features that are going to be implemented along the way. Currently, it's sitting at 174.20 as our average calculation. 169.09 is the current price at the time of recording this video. It might be something to look into. However, the one thing that concerns me, and should concern you, is this debt to equity. Everything can look great, but depending on how much you want to put weighting on these different categories, this debt to equity is concerning. As we go into a recession, which is pretty much coming up, folks, it's no secret, that might be an issue a little bit later down the line and affect all the other categories that we've shown here. So that is the video, folks, on Canadian Tire. If you want to see a company evaluated, drop it down in the comment section down below. Share this video with a friend and share the channel with a friend. If someone who's looking to learn how to invest, my channel is geared towards developing a process and get people hooked on becoming value investors, because we want to look at companies with methodically, and we're not a pump and dump channel. We're not one of those channels that are going to try to pump and dump stocks. There's enough of those channels out there. What I'm trying to do here, folks, is to make sure people avoid the mistakes that I've made in the past and develop a process. That's why I built this software here. It keeps everything clear and concise, and there's no BS around it. It's just numbers. If you disagree with me, well, then you might as well disagree with the numbers that the company is reporting to you. It's all here, folks, and what my software does is just deciphers all that information for you in an instant. So stay tuned for that. That's Canadian Tire. If you're interested, to purchase this company, I would say do more due diligence on it. But as a starting point, it's trading undervalued. Anyways, that's the video. I will see you in the next one, folks. Thank you so much for watching.